Okay, session 2. Yesterday we talked on the period setup. So we already know the accumulation stage, the stop hunt, and after the stop hunt, there are the patterns. So what are the patterns that we are waiting for?
Yes.
We have the M, the W, the 22, the V top, V bottom. The V top is basically an A, like an A, without the slash. That is
Okay.
the outside structure. The outside structure have the alpha Batman and the inverted alpha Batman. Let's start with the M pattern. So the M pattern is like this. This is the M here. Okay. So
Yes.
this is the first leg M, and this one is the second leg M. This is the second leg M. Okay. So
Okay.
the anatomy behind the M formation is that here the dealer has come out of the Asian box. So this one was the stop hunt high. See here the stop hunt, it reached the stop hunt box here.
Yes.
So this was the stop hunt high. There is the first swipe, the second swipe, and the third one. Now the dealer here is inducing people to take wrong positions. So it's inducing people to buy. So the first leg here is to induce people to buy, and in the usually people take trades on the third swipe. So people will enter buy orders here, and some of them will put the pending orders around these areas, the buy stops, so that when price reaches this area, it will continue to buy. So people buying at this area, there are some weak traders who put their stop loss near, like at the end of this candle, and mostly the ones who do the scalping, the one trading in the 5 minute chart, on the 1 minute chart, the stop loss will be near. So the dealer here would come down, fetch the stop losses, and then you come for the second leg. The second leg is used to trigger the pending orders around this area. So as he opened the pending orders here, he fetched enough liquidity for him to swing the market away. There comes the second leg. Now on the close of a candle,
Okay.
below the top of the entry triggers, below the 5 and 13 EMA. So you don't know the 5 and 13 EMA. So we take trades on the second leg of an M. So we enter here. Take trades on the second leg of an M.
Okay.
So when we talk on the uses of the indicators, you'll see how the 5 and 13 EMA play the role there. So,
and do you take the trade after that candle closes that completes the M?
yes, after the candle
Okay.
closes, completes the M. Okay, now this one is a multi-sessional M. We call it multi-sessional or multi-day, because the first leg here happened on the first day. It was the first leg, and the second day it was the second leg formation. So this one is the multi-sessional or multi-day M, and it usually happens on the peak formations. When the dealer is forming a peak, you find multi-sessional M's. Okay.
Okay. The
W formation is the opposite of an M. So here the dealer is inducing people to go short. I'm selling. So weak traders who enter short here and put their stop loss near zero will fake their stop losses. Then they'll come back to induce more people to take shorts, trigger pending orders, and here is where the dealer will open the spread.
Okay.
Here is where the dealer will open the spread, and boom, the second leg is on. I guess this is the shift candle. I guess this candle happened during news release. So if this happens before news release, we enter before news release. But if it happens and there is no news release, we call it a shift candle. It has 10 plus pips. So you end up at the shift candle there.
Okay.
So a good M, a good W has 7 candles. And this is the 15-minute chart, the 15 minutes time. So how do we count the candles? This is the first candle. The first, the second,
Okay.
the third, the fourth, fifth, the sixth, and here the seventh. So we have about 8 candles here. So for 7 candles, 7 15-minute candle, that means the dealer has worked the high or the low of the day at around 1 hour and 45 minutes. That's 7 candles. So we expect the dealer to work the lower between 1 hour and 45 minutes to 2 hours. So if you see your M has 7 candles or 7 plus candles, then it's a good M or it's a good W. We have the 22 pattern, second leg of a second leg. One of the safest pattern on the price action, they call it the triple top or the triple bottom. Like the dealer has hit the top 3 times or has hit the bottom 3 times. So here is the first leg for the M formation. So the dealer has formed an M, but has come he came back for another stop hunt. And this one is basically the third leg. So this one is the second leg of this second leg. That's why we call it the 22 pattern.
Oh, okay.
So here is our entry here. So this one is one of the patterns. So if you see it happening as an M or as a W, so it can happen as 3 hits to the bottom. 3 hits to the bottom, like this one. So you find the first leg, the second one, and it'll come for the third. And boom, it goes away. So that's a 22 pattern. We have the half a Batman. Half a Batman is basically a V top with a consolidation. So here the dealer has done the stop and high, trapped enough volume for him to swing the market away on the first leg. So from there he would consolidate around this area. That's a mild stop and it's very, very small stop and then swings the market away. So this one is the half a Batman. Like if you draw it, is like a Batman here. Yes, the nose. Okay, so this is the half a Batman.
Okay.
So this is also a pattern, but we usually take trades around this area, or for aggressive traders around the V's. So the V might happen like this, so the V top or the V bottom. When we talk of the candlestick patterns, you understand the V tops and the V bottoms. They're like the morning star and the evening star patterns. So our entry triggers, basically main entry trigger that we have is the pattern. So the pattern is important. The pattern, the pattern, the pattern. It's very important. Another thing is that the accumulation stage, the Asian box should be less than 50 ticks for a good trade during random session. And
Okay.
I advise you to take a trade after you see a visible stop hunt. And the timing there, the timing, proper timing is needed to take your entry. So for my experience, the proper timing is usually during gap time. If you see a pattern completing during gap time, it's usually a good time to take a trade. 45 minutes after gap time. Hope you're jotting that down. 45 minutes after gap time. Another good timing is the 2 hours after London Open. So here London opens at 11. So 2 hours is 13. So if the pattern presents itself around 13 to 15 hours, this is also a proper timing. And then we go to the gap time to New York. But this time, usually the dealer does the stop until he hasn't offered a pattern here. But if you see a pattern completing during gap time to New York, and then 45 minutes after the gap time, and then we go 2 hours again. 2 hours. So here it will be 16. If it's 15:30, 16:30 to, so 2 hours, around 17:30 our time to 18:30. So these are the proper time for you to take an entry. So convert them into your own time there. I hope you get me.
Yes.
You get me there.
Yes.
Okay. So another thing that, another confluence for our entry is the candlestick patterns. So if we learn the candlestick patterns, we will learn them later on. So the candlestick patterns are important for during the M formation or during the W formation. The candlestick patterns there must have the reversal patterns for us to take an entry.
Okay.
So the part of the stop hunt, how do we identify a stop hunt? Now we identify a stop hunt as the 3 swipes on the 15 minutes time frame. If the dealer comes out from the Asian, you will find 3 swipes to the low or 3 swipes to the high. And it might be 3 vector candles, and the vector candles usually occur during gap time. If you find 3 vector candles during gap times, then it's a stop hunt there. So on the last swipe of the stop hunt, you have the 3 1-minute inducements. So if you, this is the 15 minutes time frame. If you go to the 1-minute time frame and you look on the third swipe, you find 3 inducements. Let's take a look at the chart. If today there was a stop hunt, today the market moved straight away. So the stop and you see these vector candles here during gap time. Amy,
Yes.
you see these vector candles during gap time.
Yes.
So this was the stop and there. This vector candles here.
Okay.
This was the stop and low, and then the dealer rose. Oh, it's coming back. So the dealer decided to do the stop and see these three swipes. Like the first one is this one, the second one, and the third one.
Yes.
So this one was the stop and here because we know the peak is high. So we expect the dealer to go short. So this one was the stop and high, then fall. So this one is the V pattern. You see it?
Yes.
Now I've marked the third swipe here. It's in the 15 minutes time frame. So we go to the 1 minute time frame and look on the box to see the three inducements. So this one is the box here. So we can mark the inducements here. This one was really. Okay, this one was the first inducement. You see it's the first one. The second one, it is the stop and here, and this one was the third one.
Yes.
So you'll find the three inducements on the 1 minute, time frame. So there you would identify your stop ants. Euro USD. Okay.
Okay.
So if you see a stop ant like that and then the pattern presents itself, you kill it. Okay.
Okay.
You enter without fear. Now, the most important aspect when trading M and W formations is your entry. You can and you will start to get trades with zero drawdown. When I say zero drawdown, it means that you enter a trade and immediately it goes into profit. So if you wait for 2 hours, you'll be in deep profits. It's not the trades that you enter and you hold for a long time for it to go into profit, but when you trade the M's and W formations, also the V's, when you enter, you get zero drawdown. But you need to practice patience. Let the price come to you. There's no absolute need to get emotional when trading M and W formation. So if you're waiting for an M, wait for the second leg M. Wait for the candle to close on the second leg.
Okay.
So unless you're over averaging your account, you should never feel like your emotions will get the best of you when trading. These M and W setups are designed
Okay.
These M's and W setups are designed to be executed with precision and accuracy. to help you achieve the best possible risk reward ratio, because when you enter on the M, or when you enter on the W, you enter your sell orders as close to the high as possible, because your M will happen after the stop and high. So yes, the M. So you enter your orders around this area is close to the high of the day.
Okay.
So your stop loss would be near. And if you enter your buy orders on the W, you enter it on as to the lowest point as possible. So here is the W, so you enter your trades here.
Okay.
Okay. So you have the smallest stop loss among all traders. So if you have small stop loss and you have more potential for reward because you're trading in line with the peak, in line with the dealer, so your risk to reward ratio would be very, very great. Would be the best. Okay.
Okay.
The patterns are similar in different time frame. When you go to the hour 1 chart, you go to the hour 4 chart, you find the M's and W's, but we take our entries on the 15 minutes time frame. A good M or W is formed by at least 7 15 minutes candles. We've talked about that. Now, this is an example. So here there's the stop and started urination. First swipe, the second one, and the third. During gap time, there was the pattern. So our entry here is around this area here. This is an early entry,
Okay.
aggressive one, but you should wait for the price to close above this red and the yellow line there, 13 and the 5 EMA. This is the V top. This is the V.
Okay.
See here, there's the week beginning. This is the Monday. So on Monday you would find a very, very deep stop hunt. So like you see here, there's the 3 swipes. So the dealer
Yes.
has even broken the stop hunt box here, and then aggressively he returned. And throughout the week, he has been trading away from this peak here. So this is the V top. You see it?
Yes.
So your entry is there. This one is the pattern to the mile. We'll talk about this. So this one is your entry is here. You see this, it happened during the gap time. So the dealer had the stop hunt before gap time, completed the pattern during gap time. So that's the proper timing. So our Asian box, as I talked earlier, should be less than or equal to 50 pips for a perfect trade setup during London session. If you find the Asian box is blown, is greater than 50, do not trade unless you're experienced enough in MMM and you've done more homeworks, then you would trade that. So here we talk on the 15 minutes time frame only. So the London patterns which we look during the London session are the type 1, type 2, and the type 3.
Okay.
Type 1 London pattern has a visible stop hunt. So the dealer here, this was the initial high of the day, initial low of the day, but the dealer came to set the high, and then there is the M. The same to here is set the low, and there is the W. And here it has shown that the pattern has completed around the gap time.
Okay.
But usually, sometimes it doesn't do that. So you should be aware of that. So this is the type 1. I usually like this pattern. The and this type 2 London pattern. I usually like it too. So on the type 2 London pattern, the dealer shows the first leg and the second leg around the high of the initial high of the day. So the dealer doesn't set another high of the day or another low of the day. And here we have the type 3. The dealer forms the pattern at the Asian midline. So this is the Asian midline here. So the dealer would form the pattern there, and usually the 50 EMA is around that area.
Okay.
Okay.
Yes.
So Dana usually looks for this pattern and it usually tells me that is that a type 1, is that a type 2? And most of the students usually take a screenshot of this to have it on there.
Okay.
So now we come to the part where we need to understand the dealer cycle, call it the market maker cycle. Now, the market is based on 3-level cycle. Market maker will set a peak high or a peak low, and then move away from the peak 3 levels.
Okay.
So the dealer would set a peak high. Before moving the 3 levels, he would set a peak high, and then he would move the 3 levels. And in moving the 3 levels, after the first level, you'll find a consolidation. So each level has a corresponding level of consolidation. And usually the consolidation has 20 to 30 pip swings. And there's the stop and high. Then you have the second level. Then the consolidation here, stop and high. Then the third level. So we call this the market maker cycle as if it's a downtrend, there's the M, the A, and the W here. So here is where the dealer would apply the brakes. And then he would form the peak low, so the W here. So if the dealer forms the peak low here,
Yes.
he moves the first level, stop and low, rise. So this is the consolidation, stop and low, rise. And then here the dealer will apply the brakes. So we have the W, the V. This is how you identify the levels. W, V, V, M. Okay.
Okay.
So the first level is usually market maker driven. Market maker driven. It's very fast. As this one is the ideal market maker cycle. It's very perfect. See, this one is the first level here, level 1, level 2, and level 3. So the market is based on these 3 levels here.
Okay.
So this one comes as a market surprise to the retail traders. So the dealer was trading high. So the market was trading, it was trading long, but the dealers applied the brakes and then shift the markets away. So this one is it's a market surprise. It's usually fast. And here at level 2, usually it's driven by emotional traders. So level 2 is driven by emotional traders, and then the dealer would come back at level 3.
Okay.
So you'll see the dealer's hand at level 3. They would move the price further fast inducing people to take short, and then you apply the brakes. As he applies the brakes, switch the markets away. There is where he books his profits, as he would hit the stop losses for the retail traders. So here here's the market's cycle, the market maker cycle. See, there's a peak low, level 1, level 2, level 3, the peak high, level 1, level 2, level 3. Here there's the peak. Let's see. The dealer being completed the cycle here, he formed a peak reset. We talk of the peak reset, and then he went away. Okay.
So the market makers are really shifting the momentum, and then the retail emotional traders are the ones that are in the in-between.
Yes.
Is that right? So like the market makers are going to be at the top or at the bottom, and then the emotional traders are all in the middle.
Yes, in the middle. But yes, the cycle goes like that. That the emotional traders will drive the middle part, but the first part and the third is usually driven by the market maker, because the first part, the market maker switches the markets away.
Okay.
And the third part, he needs people to take trades and then for him to shift the market away. So basically these two parts here, these are the driven by the market maker.
Gotcha.
So let's talk of the trends, how the retail traders see the trends and how we see the trends.
Okay.
Let's draw a trend line here. So there's a trend line here. So there's a channel here where retail traders would mark. So as you can see here, I want to draw a trend line around this area. So the dealer was trading long. You see this area. The dealer was trading long. So the market was trading high. All retail traders see the channel as it has the higher highs, the higher lows.
Okay.
You see the higher lows, the higher highs. I hope you're familiar with those terms. Are you familiar with those terms? The higher low and the higher high. Amy,
Yes.
are you familiar with those terms? The higher high, the higher low.
Yes.
Okay. So here retail traders see that the market momentum is very the momentum is high, and the market is trending to go long. So their trend is long, and they follow the trend. But the dealer here applies the brakes, and then he shifts the market away. See how he shifts the market away?
Yes.
Very fast. So this is a market surprise. So the dealer would offer the retail traders a chance for them to draw the trend line. They would come for the stop and high. Okay.
Yes.
So the first trend line will be drawn around this area. Okay.
Okay.
And here you would find the 50 and 200 EMA would cross. These EMAs.
Yes. The
moving average.
mayo in the water. Okay. Yes.
Yes. they would cross. So this would fire a signal to the retail traders that this now is a downtrend. And all other traditional indicators will tell them the same thing. So
Okay.
they will draw the trend line, and this is the first touch of the trend line, this is the second touch, they would wait for the third touch. So the dealer would come for the third touch here. You see this. This one was a touch to the trend line, and he offered them a pattern here. So people entered around this area. They go short. Those are the aggressive ones.
Okay.
But he went up again for a stop hunt.
Yes.
So he takes them away, allows them to draw a trend line around this area. Okay.
Okay.
So he will touch the trend line, and will touch the trend line again and again. So this one is the third level, the second level going to the third level. This is where retail traders take the trades. Even if you go through Instagram and you look on the retail traders, you find that many of their trades are taken at level 3 because they're waiting for the third touch. So this one
Okay.
is the third touch now. This is the second one. This is the third one, and you come for the fourth one. So here retail traders would take trades. So they would wait for this reversal candle, take the short trades. Okay. Many of them would enter here. So when they enter, they see that the EMAs here, you find them, they are fan out. So retail traders are convinced that the momentum now is low and it's high. So the momentum is high. So the dealer now would apply the brakes after many people have been induced short, and then it would reverse the market. Okay. So the dealer is in level 3. Can you hear me?
You hear me?
Yeah, I can hear you.
Okay.
Can you hear me?
Yes.
So the dealer here has reached level 3. Having reached level 3, the dealer's objective would change. Okay. So here is where he would book the profits.
Okay.
Here is where he would book the profits. As he applies the brakes, the weak traders will be taken out. So retail traders are told that if you're taken out, if your stop loss is hit, then you go out one day. Like if your stop loss is hit today, you go out of the market, come back tomorrow, and you find another entry. And the dealer knows that. So he would stay here for 2+ days. So this is the first day he applied the brakes, and the second day is here. So after he fetched his contracts that he needs and the liquidity is good, then you see this, the trend line. If you draw the trend line well here, you'll find that even at this point, the dealer offered the retail traders another entry.
Okay.
So it would induce more people to go short here, and then boom, the market is reversed. So this is how the retail traders see the trend, and this is how we see the trend.
Okay.
So you should understand the market, as I told you right now. You should understand how retail traders look at the market and how you look at the market. So how do we know that the cycle is complete? There are 3 criteria that I look at to know that the market maker cycle is complete. The first one and the most important is the 3 levels. And the 3 levels are marked as the M, AAW, okay?
Okay.
And the WVVM. So if you see the WVVM and the MAAW, So you know that the market maker trend is complete. Another thing is the number of days. The number of days should be 3 to 5 days. Okay. So if you
Okay.
see the dealer is trading short for 3 to 5 days, but you cannot see the levels clearly, then you should anticipate that the cycle is complete. But this one goes hand in hand with the ADR. So the dealer needs to complete 3 times ADR, or he needs to complete the 3 times ADR for him to complete the cycle. So the cycle is complete once the 3 times ADR is met. So here is the 3
Okay.
times ADR. Here it's written here is 132. So the number of pips he moved from this stage to here, it should be 132 or extra. So I usually draw the ADR boxes. I don't know if Dana has taught you to draw the ADR boxes.
Yeah, I think that would help me if I've seen some charts that Dana's marked up ahead of time where he's marked the ADR boxes and then we're watching them fulfill that. That is helpful.
Okay, let me show you how I draw the ADR boxes. This is pound card here. So pound card had a reset around this area.
Okay.
So we talk of the trend reset. So here we have.
So the whole thing is complete manipulation by the market makers.
Yes, the whole thing is complete manipulation. They're in business. So this one is the M here. And I take the rectangle, okay?
Okay.
And I come to plot it here. So if you plot it for the first time, it would appear like this, and you need to highlight it to double click your mouse. So ADR times 1 here is 113, or you can read it around here. I usually use the one marked here is 113. So
Okay.
as I move my rectangle here, you see the number of pips. There is the 11 and there is the 876. You see that?
Yes. Yes.
876 now is the number of pips. You put one decimal place there is 87.6, okay?
Okay.
So you go to 113. So it's around this area.
Okay.
So the highest point the dealer has reached is this one. So to form a duplicate of this, you hold Control button on your PC, and then you drag this using your mouse. There's the
Okay.
duplicate. And you have the third one. Okay, here you cannot draw it to go to the R4. Wow. So there it might have the 3 times ADR.
Okay.
Okay. So that's how I plot the ADR times 3 boxes. So you find the dealer is completing the cycle. You see here there's the M, the A, and the 3 times ADR was made. Then there's a big peak here. You see how the cycle continues.
Yes.
This one now is level 3, typical level 3 behavior. The dealer is chopping around, using people to go more. See, the dealer moves the price further short for people to take the short trades. But his intention is to go long. The dealer is so evil sometimes. Can you hear me?
Yes.
Okay, this one was an example of the, this one is dollar index. This is an example of a market maker cycle. So here is the first level. You see the first level. The consolidation is very
Yes.
small, but we usually look on the consolidations which are significant, like this one. This one is a very good consolidation. So
Okay.
I knew that this cycle was complete because of the ADR boxes and the number of days here. The dealer spent on this cycle, so I knew that the cycle now is complete. We expect a reversal here. So the
Okay.
dealer usually use news release if the news is bad or if the news has come out good. But the cycle says that the trend is short, then the dealer would simply complete the cycle.
Okay.
So during news release, the dealer uses the, like this candle here was during the FOMIC news, and this one is dollar index. So during FOMIC news, the dealer simply completed the third level. So last week we had the pound news. The numbers were the same. There was no change on the, was it the, what was the news again? The pound news. What I said. CPI. CPI, I don't know. Yes, the CPI, yes. Yes. It was the CPI. So the numbers were the same, but the market moved.
Okay.
Spikes were there. So the dealer simply completed the cycle. So you should understand how to anticipate for the news. So before news release, you should know that the market would go long or would go short, because you know the market make a cycle.
Okay.
So we shall talk on the weekly cycle now. So the weekly cycle, it shows what the dealer does the whole week.
Okay.
But this should align with your market maker cycle. So you should understand the position you are with the dealer. Like here, we know that this was Monday, Tuesday going Wednesday. So we know that we are in level 2. The dealer should complete the third level and then make a reversal. Now, how would he do that? How would he do that? The dealer might. So the dealer on Monday going Tuesday, he would have a false move. If the intention is to sell, he would first buy. So here we have a false move, and the false move is usually 3 swipes. So the number 3 is used by the dealer very much. So here is the first swipe, second, and the third one. And here he formed the M now. You see?
Yes. Yes.
Then he traded the first level, the second one, and here is the third. So if his intention is to sell, he would first buy as the false move to induce people. This is the trap zone, and then you trade away from the trap zone, and then on Friday, you will come back to the range. Okay?
Okay.
Now let's talk of the news release now. Suppose our news release was on Monday or on Tuesday. On Monday or early Tuesday. Early Tuesday means before New York. We would expect the dealer to use the news to do the false move. So if you know that this week the dealer will go short, so the news on Monday or Tuesday early, he would use it for faking. So he would go long, and then he would reverse the market.
Okay.
Any news around this from Tuesday, New York, going to Thursday, end of Thursday, the dealer would use the news to complete the cycle. So if the cycle is short, you simply go short before the news, and then the news would come there and the dealer would sell. On Friday now, we know the dealer would come back to the midweek range. So if he's selling, he was selling throughout the week. Now on Friday, the dealer would buy. So if the news release is on Friday, we would expect the dealer to buy.
Okay.
So I'm giving you a task on Friday, this Friday. We have card news, okay?
Okay.
During gap time of New York. So early New York. Gap time before New York. The gap time there before New York. Here is 15:30 hours. So we would have the card news. You go to Forex Factory and you would find the card news. So on Friday, I would ask you where USD card would go. So you need to watch USD card, what it has done from Monday, Tuesday, Wednesday, going tomorrow, for you to anticipate on Friday the movement. Okay?
Okay.
So that's it. USD card. So this one was another example of a weekly cycle, and you see this one was the stop and high pulse move. So the dealer basically formed a peak on Friday here. So it simply came here to form the second leg on higher time frame. So this was the first leg on the higher time frame, and this one was the second one. And then boom, the three levels. On Friday came back to midweek range. You see this spike here. There was a
Yes.
news release. So the dealer simply used the news to complete the cycle. So this one was the USD Swiss franc, stop and low, and then they would buy throughout. On Friday, it simply consolidated. So
Okay.
level 3. Having reached level 3, the dealer's objective changes. Price would drop or rise a bit further to demonstrate further bearish or bullish movement, satisfying various criteria of the trader. So the retail traders would have their criteria for taking a short trade or a long trade around level 3. However, they will pull back away quickly, move price away, and book a profit. So level 3 will appear disorganized, with price chopping back and forth, usually within a wide range, like what we have seen on the Euro Yen. Euro Yen, where is Euro Yen? It is. See this level 3 here. Price chopping back and forth. So this is basically a very good level 3 behavior.
Okay.
So level 3 will appear disorganized, price chopping back and forth within a wide range. When traders lose money, they take a day off to reevaluate their decisions. Market makers know this and must chop the market to bring them back into play. Then the cycle continues. So they will chop the market around there for 2+ days. Then the retail traders will come back to the fray, and then they'll enter again a trade, and then they'll take this. So they'll shift the cycle away. So this one is an example of third level. You see the dealer has applied the first break here. Then he demonstrated further bearish movement. then off, it went up. You can simply draw the trend lines here and see how the retail traders were taking trades.
Okay.
So having reached level 3, you should expect one of the following. The first thing that you should expect is reversal. If you see the MAAW, expect a reversal from there. That's the first thing that you should expect. Okay.
Okay.
But if the dealer hasn't completed the 3 times ADR, okay,
Okay.
and the 3 levels are there, and the number of days that the 3 levels have taken is maybe less than 3 days,
Okay.
or 3 days on point. So you should expect the dealer to complete the ADR times 3. How would he do that? How would he do that? He would offer what we call a 333 trade. He would offer a 333 trade. A 333 trade occurs. Let's draw a market maker cycle here and a deal market maker cycle. So
Okay.
here we have our 3rd level, but the ADR times 3 maybe is around this area here.
Okay.
So the dealer here would chop and it would offer 3 intraday levels to complete the ADR times 3. Okay?
Okay.
So this one, we call it a 333 trade.
Okay.
The dealer is in level 3 and he moved again 3 intraday levels. So from there, you should now expect a reversal. Sometimes the dealer might extend a peak because we know the dealer has to verify various criteria for the retail traders to take a trade. So you would find a peak extension, like the price is extended further. So if that happens, it's well and good. You know, you would see that an extension is done because of a certain criteria on the higher time frames, of which we will talk about. When we come to talk about the daily chart, the position of the EMAs in the daily chart, or the price action zones. So you find the dealer might extend the peak because of those criteria.
Okay.
Another thing that you should expect is the reset, but the reset occurs once the dealer has moved 1.5 ADR. Now,
Okay.
let's look on the charts. This is an ideal market mega cycle. You see this. 3 levels, and then a reversal. This is called JPY. And this was May going to June. Okay, only 2 months.
Okay.
This is USD ZAR. Now, how do we define a peak reset? Peak reset is defined as the dealer has moved 3 levels, he has completed the cycle. Okay. It forms a peak here, peak formation high. He moves 1 to 1.5 ADR. 1 to 1.5 ADR.
Okay.
Then the dealer forms another peak here. And then 3 more levels are seen. Now this one is the peak reset. And this peak reset is confirmed once the dealer has broken this previous peak. So this one is
okay.
peak. So the dealer once it breaks the previous peak, there we know that this is the reset. Sometimes you would find the dealer forming this and you come here, but it would form a big M and then you continue the cycle. So you need to find the dealer breaking this previous peak, like what he did here. This one was the peak. He moved from the peak reset here. He moved level 1, level 2, and here level 3. Will come to form a peak here. This now is the peak reset. This was another cycle. And
Okay.
peak resets now occurs on the EMAs. You see here, this is a confirmed reset. This is an unconfirmed, a confirmed, an unconfirmed reset. A
Oh,
confirmed
okay.
because the dealer has broken the previous peak. This one is a 333 trade. Like the 3 levels, and the dealer offered the 333 here. A peak extension can be seen on this dollar index. This was the peak here. This is our 4 time frame. The levels now, when you talk of the levels are visible on all time frames, but are highly visible on our 1 time frame. We use our 1 time frame to identify the levels, okay?
Okay.
But when you draw the ADR boxes, they would appear also on the hour 4 daily on the 15 minutes. So you can see the cycle from here.
Okay.
So this is the hour 4 time frame. So the cycle had completed here. This was the first. This was the first level, the second, the third. And the ADR time 3 was completed. But the dealer here formed a peak extension. You see,
Okay.
this one was the extension. Now, when we look on the TDI of the hour 4, just look here, and when we move forward there, when we talk of the TDI, you would understand more. So here was the peak of the TDI. This one was the peak. This one was the first level, the second level, and the third level. So we expected a peak here for a peak formation high, but the dealer extended. So our peak extension is this one. So you would identify a peak extension also on the TDI of the
Okay.
hour 4. But this TDI is only on the hour 4 time frame. You would find the levels, you find the peak extension. Now,
Yes.
do not confuse the levels with the Elliott waves. You'll find someone drawing the Elliott waves. This is retail trade, it's not market maker trade. Okay, for today, we would end here.
Okay.
So then here, meet again tomorrow for the chart setup. Here we'll talk of the candlestick patterns and the indicators. After that, we'll talk of the peak and the peak reset again, while combining the indicators and the candlestick patterns. Then we'll talk of the entry triggers, then the peak trades and the another trades away from the peak trades, and then from there you will be able to mark your charts and to take entries.
Okay.
Okay. So for today we end here.
Sounds good. Thank you.
No question?
No, not yet.
Okay. Thank you for today.
All right. Thank you.
My homework.
Okay.
Okay.